Welcome back to Scalping Profit Zone, the home of high probability setups, precision entries, and real-time execution that actually makes sense in a market this chaotic. If you are watching this on May 17th, understand one thing before anything else. You are sitting inside one of the most critical monthly decision points Bitcoin has printed all year. Not weekly, not daily, monthly. And the next few hours are going to define where this market moves for the rest of May and possibly into June. No guessing, no recycled takes, no generic analysis, just structure, levels, and execution, the way it should be done. Today we are breaking down exactly what is happening with BTC right now. The overnight liquidations, the macro chaos, the whale manipulation, and most importantly, where the real scalping opportunities are hiding inside all of this confusion. Stay locked in, because this one genuinely matters. Let us be completely honest about where we are right now, because sugarcoating this market will get you liquidated. Bitcoin recently attempted a push toward the $82,000 level and got aggressively and decisively rejected. That single rejection triggered a $550 million long liquidation flush that wiped out over-leveraged longs across every major exchange and dragged price down hard into the $78,000 range in a matter of hours. That is not a small move. That is a warning. What caused this level of destruction? Sticky inflation data came in hotter than the market expected on both CPI and PPI. Rising Treasury yields started creating serious pressure across all risk assets. Global macro uncertainty forced institutional caution across the board. And quietly, methodically, whale wallets were layering sell orders above $81,000 long before retail traders even noticed. But here is where the story gets genuinely interesting and why this market is so dangerous to trade without the full picture. Despite that brutal flush, spot ETF demand has not died. Institutional buyers are still accumulating on every significant dip. The major players in the ETF space are not running scared. They are loading their positions at discounted prices while retail panic sells into their bids. So what we have right now is a direct and violent collision between two extremely powerful forces: institutional spot buying pressure pushing from below, macro headwinds, and whale distribution pressing down from above. The result of that collision is a brutal, choppy, unforgiving battleground, sitting right inside the $78,000 to $80,000 psychological zone. This is the battlefield, and this is exactly where discipline separates profitable scalpers from blown accounts. Now let us go through the full multi-timeframe breakdown so you know exactly what each chart is telling you right now. Starting on the 15-minute chart, because this is where your entries and exits actually live, price is currently printing lower highs on the M15, which tells you that intraday selling pressure is still in control of the short-term narrative. The 21 EMA and 50 EMA are both sloping downward and acting as dynamic resistance on every single bounce attempt. There is a liquidity pool sitting just below $78,200, a dense cluster of stop losses that price will very likely sweep before any real or sustained bounce attempt develops. What you need to see before considering any long scalp on this time frame is a microstructure shift. Specifically, you are looking for a strong, bullish, engulfing candle closing above the 21 EMA with volume behind it. Until that confirmation appears, short scalps on clean rejections at the 50 EMA remain the higher probability play. Your key scalp resistance levels on M15 are $79,400 and $79,800. Moving to the 1-hour chart gives us a cleaner picture of local trend direction. The H1 is currently in a bearish short-term trend. Lower highs, lower lows, no meaningful recovery of structure yet. The volume profile is showing a significant gap between $79,500 and $80,800, which means if price enters that zone, it will move fast and it will move with very little friction in either direction. The key level to watch here is $78,900. This was previous support that broke and has now flipped into resistance on any bounce. For a genuine trend reversal on the hourly, you need a clean close above $79,800 with expanding volume behind it. Anything less than that is a fake-out trap designed to shake out premature longs. The volume point of control on the recent daily range is sitting near $79,200, and that is the magnet price keeps gravitating back toward. The 4-hour chart is where smart money left its clearest footprints and where you need to pay the most careful attention. The H4 shows a clear market structure, break to the downside from the $82,000 rejection zone. There is a strong, bearish order block sitting between $8,500 and $81,200. This is precisely where institutional sellers offloaded their positions heavily, and that zone will act as a significant ceiling on any recovery rally that attempts to push through. The flush from $82,000 all the way down to $78,000 was a textbook liquidity grab. Smart money hunted every stop loss sitting below the range lows before potentially repositioning for the next directional move. The 4-hour 200 EMA is now sitting near $80,100, and reclaiming this level on a confirmed candle close is the first real signal of any meaningful recovery. Until $80,400 is reclaimed on a 4-hour close, the path of least resistance on this time frame remains pointing downward. The daily chart tells the real story and sets the entire context for everything else. Bitcoin is sitting just above one of the most critical Fibonacci levels on the entire chart. The 0.236 retracement at $77,780. This level is held as structural support, and losing it on a daily close opens the door to a much deeper and faster correction than most traders are currently pricing in. The daily 50 EMA is being tested right now, and how price reacts to it over the next 48 to 72 hours will define the midterm trend direction for the entire month. On-chain data does support the recovery case. Long-term holders have not moved their coins in significant quantities, and exchange outflows remain elevated, suggesting genuine accumulation at these levels. However, the daily stochastic RSI is cooling off from overbought territory, meaning there is technically still room for more downside before a healthy reset completes. The broader midterm structure remains bullish, as long as $77,780 holds on a daily closing basis. One daily close below that level changes the entire narrative. Now, this next section is what most channels will never explain to you, and it is exactly why so many traders are getting absolutely destroyed in this market right now. On one side, you have a genuinely and powerfully bullish narrative. ETF inflows are consistent, growing, and showing no signs of institutional panic. Long-term holders are not selling at these levels. Exchange reserves are declining, which means coins are leaving exchanges rather than entering them, a historically bullish signal. Institutional interest has never been higher in the history of this asset. On the other side, you have a genuinely and dangerously bearish macro backdrop. Treasury yields are rising aggressively, and risk assets suffer hard when yields spike at this pace. Rate cut expectations have been pushed further back, and the Federal Reserve is not coming to the rescue anytime soon. CPI and PPI both printed hot, which means inflation is proving far stickier than the market had priced in. And technically, the stochastic RSI on the daily is resetting from overbought conditions, meaning the chart itself still has room to move lower before completing its reset cycle. Here is the dangerous and deadly result of these two forces crashing into each other. Bitcoin is trapped inside a range, and ranges kill undisciplined traders more efficiently than any trend ever could. Price fakes a breakdown, shorts pile in aggressively, price rips back up, shorts get liquidated clean. Price fakes a breakout, longs pile in with confidence. Price dumps straight back down, longs get wiped. Both sides are getting hunted simultaneously. This is not random market noise. This is precisely how smart money operates inside a range, before committing to a real directional move. The undisciplined trader reacts to every candle. The disciplined scalper waits for confirmation and lets the noise kill everyone else first. Here is the directional picture, with complete clarity. The short-term bias is cautiously bearish to neutral for as long as price remains below the $70,800 to $80,100 zone. If that zone is reclaimed with strong volume on a confirmed 1-hour close, the bias flips to cautiously bullish. The word cautiously matters in both directions because this market does not reward overconfidence right now. For bulls to take control, they need to clear levels in sequence with conviction. The first test is $79,800, which is the previous structure that needs to flip from resistance back to support. The next ceiling is the bearish order block zone between $80,500 and $81,200, where heavy institutional selling previously occurred. If $80,500 breaks with genuine volume, the next target becomes $82,500. And if bulls can produce a clean weekly close above $83,000, that becomes the major breakout trigger that reopens the path toward $88,000 and ultimately $90,000. For bears, the levels work as follows. The $78,000 psychological floor is the immediate battleground and will generate bounces simply due to the emotional weight it carries at a round number. The $77,780 Fibonacci level is the hard structural line in the sand. This is non-negotiable. A confirmed daily close below $77,780 is a serious and urgent warning signal that demands immediate attention. If that level breaks cleanly, the next major structural target to the downside becomes $74,600, which would represent a full and painful reset of the entire recent rally. Here is the professional execution approach for trading this exact setup right now. Do not anticipate. Wait for confirmation before every single entry. Entering longs before price reclaims $79,800 on the hourly is gambling dressed up as trading. The setup is simply not ready yet, and forcing it will cost you. Respect the order block ceiling with discipline. If price rallies into the $8,500 to $81,200 zone, that is a high probability short scalp zone, not a breakout buy zone. Wait for a clean rejection before considering a short entry, or wait for a strong volume-fueled breakout before buying any continuation above that level. Protect your capital inside the chop. The $78,000 to $80,000 range is a meat grinder right now, and it will remain that way until one side breaks with conviction. Tight stops, smaller position sizes, and fewer high-quality trades are the correct and professional response to this environment. Not more trades with wider stops hoping something works. Mark your levels before price reaches them. The worst possible moment to make a trading decision is when price is already sitting at the level and the candle is closing in real time. Mark $79,800, $80,500, $78,000, and $77,780 on your chart right now. Know your complete plan before price arrives at each level? Manage risk first without exception. In high-leverage flush environments like the one we are navigating right now, the traders who survive and ultimately thrive are not necessarily the ones who called the direction correctly. They are the ones who sized their positions correctly, kept their stops appropriately tight, and lived to trade another session. Before we close out, I want to hear directly from you right now. Drop your answer in the comments below and be specific about it. Are you buying the $78,000 dip and targeting a push toward $80,500? Or are you waiting for price to reclaim $80,500 first and then looking for a short rejection back into the range? Tell me your exact plan and your reasoning, and I will give you direct and honest feedback on your setup. If this breakdown gave you real clarity inside a genuinely chaotic market, then hit the like button right now. It takes 1 second, and it helps this channel reach more serious traders who need this kind of structured analysis. Subscribe and turn on notifications so you never miss a live trading zone, a real-time scalp setup, or a critical market update at a moment that actually matters. That is the complete breakdown for May 17th. Levels are mapped. Bias is defined. Execution plan is clear. Remember what we always say here at Scalping Profit Zone. The market rewards patience consistently and without exception. It punishes emotion just as consistently. Manage your risk. Respect your stop losses every single time. Trust the structure and the levels, not the hype and not the noise. Trade smart. Trade safe. This is Scalping Profit Zone, and we will see you in the next live session. Risk disclaimer. This content is for educational and informational purposes only and does not constitute financial advice. Always conduct your own research and manage your risk responsibly.